Hi! If you're a regular reader of MoneyWeek magazine, you may have noticed that we often talk about the Shiller PE ratio, and we use it to see whether a particular stock market is overvalued or not. So I thought I'd do a video explaining how the ratio works and see what it tells us about markets right now. So, Shiller PE, obviously PE stands for price earnings ratio. We've explained the price earnings ratio in previous videos, but just as a really quick recap, this is just the normal price earnings ratio is share price over earnings per share, which is a measure of profit. So if we do an imaginary company, let's call it ABC, share price is £1, earnings per share is 10p, we'll get a PE ratio of 10. That's the normal conventional PE ratio. Everything else being equal, I'd say that company looks a bit cheap. Now, the price earnings ratio has many defects, and one of the big ones is that it doesn't take into account the economic cycle. So if we're at the top of the economic cycle when times are good and we're in a boom, you'd expect that earnings per share figure to move up, say to 12.5p. And if the share price doesn't change, suddenly the PE falls to 8. £1, 12.5p, divide them, you get a PE of 8. So the company looks cheaper, but really nothing's changed. The company hasn't got any more efficient, it hasn't become in an underlying way more successful. All that's changed is the economy's got better. We're at the top of the economic cycle. So an investor called Benjamin Graham in the 30s, who's one of the real investment greats, he was aware of this problem. He said, let's average out those earnings per share figures over a period of 5 or 10 years, then calculate the PE ratio with the average profits figure, and that will give a better reflection of the underlying strength of the business. So that's great, that's useful. Then in the 80s, an economist called Robert Shiller came along. He said, let's take it another step forward. Let's also take into account inflation. So if we're looking at this company, ABC, let's also think about inflation. So this, let's say, let's imagine we're at the top of the economic cycle. Last year, year one, the earnings per share was 12.5p. Year before was 10p. 10 years ago, the EPS was 4p. 9 years ago, it was 5.5p, and obviously you've got other figures in between. So Benjamin Graham would just add up all these different earnings figures, all 10, and average them out. But Shiller says, no, let's adjust for inflation. So let's say there's been 40% inflation over the last 10 years. So that moves the EPS figure to 5.6p. Let's say there was 30% inflation over the last 9 years. We've got an EPS of 5p here. That gives us an inflation adjusted figure of 6.5p, and so on. We then average out those inflation adjusted numbers. Let's say the average is 8p, put the share price over, and we have a Shiller PE of 12.5. That perhaps better reflects the true strength of the company than just the normal PE ratio. It's looking at all the earnings over the last 10 years and giving us an average which tells the true strength of the company. Now, as I said a minute ago, here at MoneyWeek, we tend to use the Shiller ratio to look at individual stock markets, and we're not alone in that. So, and most often, people use it to look at the S&P index, which is the biggest, most important index in the US. So right now, if you looked at the S&P, its current ordinary PE ratio is 16. So that says to me, well, you know, the US looks sort of not too cheap, but not too expensive. Not that bad. But let's look at the Shiller PE ratio for the S&P. Wow, 25, a lot higher. And now I'm thinking, crikey, the American market looks expensive. Should I really be buying shares in America right now? Let's see you know, how things have gone in other periods of history. I mean, the historical average is 16 for the Shiller PE, but probably its highest number ever was in March 2000, when the Shiller PE was 43.8. That was just before the whole dot-com crash. And actually, Robert Shiller at that moment published a book called Irrational Exuberance, and he said the stock market was way overvalued. And my goodness, he was right. Back then, I was a young, naive investor, and I didn't believe him, but the numbers were telling the story. America was way overvalued. I wish I'd sold all my shares at that stage. And let's look at another interesting moment in history, early 2009, when we were in the whole middle of the whole credit crunch financial crash. The conventional PE ratio at that time was around 47. So that was saying the market was really expensive. But that seems counterintuitive because share prices were crashing. How could the PE ratio be high when share prices were crashing? Well, the reason was because earnings here was falling even faster than the share price. So seemingly the American market was expensive. It wasn't. If you look at the Shiller PE for 2009, it was more like 13, a real buy signal. The markets were cheap. It was time to buy. And thankfully, I did buy a few shares at that point. So as I say, it's most useful, this ratio, to look at individual markets, but you can look at it for companies, and you can get data for individual American companies at a website called Guru Focus. There's no website, sadly, that gives you Shiller PEs for UK companies. You just have to work them out yourself. If you want to get some Shiller PE figures for different markets around the world, a great website is called Ideas Farm. It's run by a guy called Meben Faber, who's a real enthusiast for the Shiller PE ratio. And obviously MoneyWeek magazine will continue to look at Shiller PEs for markets around the world. But right now the message is America looks pricey. I hope you found it useful. I hope you now understand the concept. I'll be back with some more videos very soon. So until then, good luck with your investing.